Investors Chronicle.
Hello and welcome to the IC Interviews podcast. I'm Val Cipriani, personal finance editor at Investors Chronicle, and today I am joined by James Cook, manager of the JPMorgan Global Growth and Income Trust. So the trust has quite an interesting strategy. As the name suggests, it aims to provide both growth and income to its shareholders using a total return approach. It's done really well. Performance-wise, it has been consistently ahead of its benchmark, the MSCI All Country World Index. And at the moment, it is the only trust in the Association of Investment Companies Global and Global Equity Income sectors that is trading at a premium, albeit a small one, and not at a discount. So James, thank you very much for coming on the podcast. How are you doing?
Yeah, thank you very much, Val. Thank you for having me. I'm glad to be here.
Great. So let's maybe start from the beginning a little bit. Could you quickly explain your strategy of combining growth and income to listeners? Because it is quite unique. How does it all work?
Yeah, absolutely. So first of all, JPMorgan Global Growth and Income, which I'll probably refer from here on to as JGGI, which is our ticker. We're looking for the best 50 or so ideas across our research platform, where we cover around 2,500 companies. So if you think about that, less than 3% of the companies we look at make the final portfolio. That's an incredibly high hurdle rate. And it's what, in my mind, makes this one of the highest conviction strategies in the market today. So I appreciate that there's more concentrated strategies out there. There's the 20, 30 stock portfolios. But when you think about the number of stocks in the portfolio relative to our opportunity set, in my mind, this is one of the highest conviction fundamental strategies. Now, we can go anywhere in the world to find those best ideas. So we can go all the way into sort of the value part of the market. We can go all the way into the growth part of the market. And, at a portfolio level, really what we're trying to achieve is to give fundamental characteristics that are superior to the market. So we want to offer superior quality of earnings. So think about your companies with high barriers to entry, high barriers to profitability, resilient earnings through the cycle. We want to be able to outgrow the market in terms of earnings per share. And finally, we want these two characteristics. Ideally, we want them for free. We want to be able to offer a similar, if not better, valuation than the market. And I appreciate that sounds all relatively simplistic, but the reality is it's not. Less than 3% of the companies that we look at can offer you all three of these characteristics. So to build a portfolio that can do that requires an enormous amount of breadth of ideas. And that's the advantage of investing with JPMorgan Asset Management, is the 2,500 companies that we look at, so that we can build a portfolio with these superior attributes. And many times when we're looking for these high quality businesses, investors will turn around and say, well, I think high quality companies look overvalued right now. And in aggregate, that's probably a relatively fair statement. But that's not to say that we can't go and find individual stocks, high quality individual stocks that are attractively valued.
No, of course. And so basically the way the trust operates is that it tries to pay out about 4% of its NAV every year to shareholders. But it doesn't do it like many other income trusts, which would try and hold mostly income generating companies and then sort of take the dividends and give them to the shareholders. It does it in a bit of a different way. Can you say a bit about that and how that works?
Yeah, absolutely. So we give a 4% payout policy. So we pay 4% of the net asset value out in 4 quarterly equal installments. That's set by the board at the start of the financial year. It was raised quite significantly from last year by the board. And as I say, that is a board decision. Now, we don't have to go and find those dividends for our shareholders. We can actually sometimes pay it out of capital. So right now, the portfolio has a dividend yield of around 2%. But the advantage of not having to go out and find these high yielding stocks to pay that dividend means that we can go and find the most attractive stocks on a total return basis, which is a superior way of looking at the world from our perspective. So as I say, when we think about looking at stocks, it's really about the total expected return rather than thinking about dividends or growth. And we just repackage that for you to give you a nice balance. And when we think about what are the criteria we're looking for in terms of a stock to make the portfolios. I talked about that 2,500 coming down to the best 50 or so ideas. It's really threefold. First of all, it's, we need to see significant valuation upside in the stock. And at the heart of our philosophy, we believe that the value of a company is driven by a combination of its long-term earnings power, what it can earn through the cycle and beyond, and then what the quality of those cash flows is worth. So once our analysts have thought about the barriers to entry, how high quality this business is, they'll apply what multiple they believe those long-term earnings should be valued at. You combine the two and you get to an expected return of a stock. And we're naturally going to look to buy the stock with the highest expected returns. However, we're aware that undervalued businesses can remain so for prolonged periods. So the second piece we really look for is, what insight do we have into this business? What's our edge versus the street? Where do we differ in terms of earnings, et cetera, or view? Sometimes it's duration. But insight's also incredibly important because it helps us to understand when many of these companies, and even the best companies, will go through difficulty at one point, whether that difficulty is a crack in the long-term investment thesis that ideally we need to be getting out sort of relatively early, or is it something that's short-term in nature and we should suddenly get a better valuation opportunity to add to the stock? And again, we have a lot of data to suggest that our adding and trimming is very additive to the performance of the portfolio. We can only do that if we have insight into the business. And then finally is the last element, which is you have all the valuation upside in a stock, you can have all the insight into the business. But if the company doesn't control its destiny, it can all be for nothing. And as an ex-financial PM, I've seen that many times before. So what we're really looking for is what we call the high conviction piece, which is, does this company really control its outcome? So we want stocks that have strong balance sheets, resilient earnings, so they're not taken out by the economic cycle. And the second piece we're looking for is, are there, again, those sort of that quality, high barriers to entry, high barriers to profitability, so their destiny is not driven by their competition. And that really helps take you from the 2,500 stocks down to that best 50 or so ideas.
Yeah, we'll definitely discuss some of the sort of big names in your portfolio in a bit. I did want to ask you something about the strategy again first. How do you manage that, necessity sometimes of, paying the dividend out of the capital? Because it does, suggest that you might potentially be forced to sell at a moment that might not be ideal sometimes.
Yeah, that's a really good point. And it's something that actually differentiates us from many of the other investment trusts out there. So JGGI is a highly liquid portfolio. We're only investing in stocks. I don't think there's anything in the portfolio today that is under $40 billion in market cap. So this is all highly, highly liquid. Now, as of today, we actually don't even need to sell stock to pay for the dividend, because the amount of money that we're issuing, because of people are coming into the strategy, we're doing net issuance and that's bringing cash in. So we don't, in fact, really have to do much of that paying out for the dividend. If, however, that was to stop, then yes, we would have to sell part of our holdings. We wouldn't ever have to rely on any individual stock. There's no liquidity issues in the way that there may be in other parts of the investment trust that are a lot less liquid than ours. And the other part that I'd also make is, not only is the underlying portfolio highly liquid, but also actually on a relative basis, the investment trust itself, in other words, investors buying and selling shares of JGGI is actually pretty liquid too.
Yeah, definitely. In terms of, you were talking about the liquidity in the portfolio. As I was looking at the fact sheet, that does seem to be quite a bit at the moment. So you had like around 5% in cash as of the end of June. So the trust, like most trusts, has the ability to gear, but is not geared at the moment. And I did kind of wonder, if that says something about how you feel about the market in general, like, how do you see things going in the next few months?
Yeah, absolutely. Great question. So just to be clear, the 5% that you're probably picking up, that is our debt facility that you're picking up. We have about 5% of the net asset value in a debt facility. Now, currently, we're 100% invested in the market. we can go anywhere from about 5% net cash all the way up to 20% geared. And as I say, we're currently, 100% invested. We're neither cash, but nor are we taking any gearing either. And that is because of, the way we look at the market, as you've sort of pointed to, is that there's three pieces when we think about it. The first piece is valuation. And the long-term valuation of the market is a little bit above historical average. Now, when you look at the equity market now relative to bonds, for example, over the last 10 years, equities definitely look very overvalued. But that's because we've been in a zero rate environment. If we were to take a much longer time frame perspective, then actually equities look relatively fair value. Needless to say, either way, equities are neither, at a valuation perspective, they're neither particularly compelling nor are they particularly demanding either. The second piece that we look at is the earnings outlook over the next 5 years. And that's where we have our most concern. If you take a step back and you look at the global equity markets during normal environments, let's take 2011, so we've got past the global financial crisis, the world's begun to normalize a little bit, and you go all the way to 2019. Global profit margins over that 9-year span were effectively around 11%, and they fluctuated no more than 1% either side, above or below that number. They were incredibly stable. COVID hits, demand, goes through the roof because we had that fiscal stimulus levels that we haven't seen really since the Spanish flu pandemic. And at the same time, we've got the supply constraints. Now, every macroeconomist in the world will go and tell you the combination of those two will lead to record profit margins. And that's exactly what unfolded. Record profit margins of around 15% at I forget whether it was Q1 or Q2 in 2022. Then by around the middle of 2022, supply began to ease, profit margins began to come down. And what we think is likely to unfold next is demand normalization is going to begin to take place, and the Fed is doing absolutely everything it can to pull liquidity out of the system. Now, when that happens, we think what's more likely to unfold is that there's downside risk to where profit margins are today. Now, the market has a different perspective. The market believes profit margins will go back to peak and then surpass. And we just think that's unrealistic when we look at history and we look at the environment that unfolded to achieve those profit margins. So that's where our major concern is. And again, that doesn't impact all stocks equally, but where it really impacts the market is in the low growth cyclical part. And that's where we have most of our underweight positions. Then finally is with regards to dislocation. And dislocation in the market is very high right now. And that's because of all the macro uncertainty unfolding. We are in the year of the election, and France gave us a rude awakening of what that can look like. So dislocation is good, though, for fundamental stock pickers. It means our opportunity to find high quality, attractively valued businesses is high, and our ability to outperform should hopefully, we still have that ability to do so. So for that reason, we've got one thing looking pretty good, which is the dislocation in the market. Earnings don't look particularly attractive, and nor does valuation, which is why we're sort of sitting neither in cash nor are we gearing the portfolio.
And is there any areas of the market that look particularly interesting to you right now? So, I'm thinking, countries, sectors, anything you can think of, really.
Yeah, so I'll point maybe towards two, and they're quite in the different extremes. So within defensives, valuations, long-term valuations haven't looked this attractive really since about 2009 and prior to that. So valuations of defensives are the most attractive part in aggregate right now. But when you hone in even deeper, where we're most excited within the defensive part of the market is the defensive consumer. Now, this part of the market has had a pretty good time during COVID, when we were, all stocking up on more spirits, etc. Then what unfolded is there was a huge amount of cost inflation in this part of the business. So we saw crop prices going up, we saw commodity prices, which impact, the beer cans, etc. That was unfolding at the same time. And these defensive consumer businesses thought that they could price accordingly with that, and in fact take margins. We thought that was, again, unrealistic assumption. And what unfolded in most parts of that is when they were taking price, they lost volumes, with the exception of one of the stocks that we did hold during this period when we were underweight, which was Coca-Cola, that had the pricing power to take margin and take volumes too. Now, what's happened since over the last year is that a lot of these excesses have come out, the pricing has come down, margins have been weak, volumes have been weak, and on the back of that, valuations have come down to much more attractive levels. So when we've flushed out a lot of the problems, valuations are becoming a lot more attractive, and that's when, as of the start of this year, we started leaning back into consumer staple businesses. The second part, I'm going to go all the way to the other extreme now, is a lot higher growth and a lot more cyclical, which is the semiconductor cycle. Again, we have a pretty reasonable overweight here. It's been the best performing space over the last 1, 3, 5, 10 years. This has been a very good compounding part of the market. And within this space, where we've been leaning into most recently has been the memory part of the market. And again, you've sort of come from this very high cycle, so about 60% of memory demand is used in PCs and smartphones. And this part of the market had a very good time during COVID, as we all got those cash checks, and that's what we spent our money on. And as sort of come into one of the most steep downward cycles, that's now beginning to level off. So there's sort of this cyclical upside potential. And at the same time, what we think AI potentially means is, as we go from the lower sort of power memory to the high power memory, it's going to take out about 20% of supply, we think. In a couple of years' time, 20% of supply will come out of the memory cycle, because to produce the high-performing memory chip requires 3 times the amount of wafers. At the same time, we think demand is also going to improve quite significantly if we put more AI functionality onto the smartphone. So currently, a typical smartphone will come with something like an 8 gigabyte of memory. We think that might have to increase up to 16 gigabytes if you want to do a lot of that memory workflow on the smartphone itself, and therefore quite a significant amount of demand up there.
Because you sort of brought up semiconductors, let's maybe talk about them a little bit. So Taiwan Semiconductor is one of your top 10 stocks, and I mean, the sector has had a bit of a tough week off the back of Donald Trump making some comments that were not received very, very well in terms of sort of how Taiwan basically should pay for its own defense and the relationship with China and all that. And I wanted to ask you, obviously Biden's retired his nomination, but Trump looks quite well placed still. How much of a risk is for these stocks the perspective of a Trump presidency, or indeed for other parts of the portfolio? What could it change in a way?
Yeah, it's always honestly very difficult for us to try and predict that to a high degree. You mentioned tech and semis, but it's also playing out in the auto space as well. Will tariffs come in and prevent Chinese auto producers from coming in and impacting Europeans and the likes of Tesla as well? And it's quite an interesting one, because Chinese OEMs are actually far more efficient at producing cars than either Europeans or the US is. And again, impacting areas in retail such as cognac and luxury goods within France. So the actual overall geopolitical risk has far-reaching sectors, and even some that on the face of it we hadn't originally expected. Maybe in particular, because you asked about TSMC, but just to sort of flag, I don't think it's really in anybody's interest to target TSMC. So what we've seen so far on the geopolitical front, Biden administration came out with it, and that'll be much broader than probably just Biden, but that'll be the Democrats as well, is putting more restrictions on China and selling high-end equipment into that. That's why we saw a large part of the semiconductor equipment names coming off quite sharply last week. But in reality, I don't think it's good for anybody to ban or impact the likes of TSMC. They are the number one foundry in the world, and they have an even higher market share in leading edge foundries. So you're going to need them, for no matter which part of the GPUs, memories, part of the cycle that you need chips for.
Yeah, of course. Let's have maybe a better look at what the portfolio looks like at the moment. So the sort of big Magnificent Seven stock. You've got Microsoft, Amazon, Apple, Nvidia, and Meta. They're pretty much at the top of the portfolio. They account for about 27% of it as of the end of June. And that's quite an active position compared to the benchmark, which I think is in the region of 16, 17%. So do you think that these like big stocks will keep on dominating the markets? That there is definitely like a lot of talk from active managers about, the markets needing to broaden out at some point. What's your view around that?
Yeah, it's obviously very topical right now. And maybe just to give you a little bit of history on the Mag 7, our positioning. I mean, over the last 5 years, we've been broadly neutral to the Mag 7, but we've made a significant amount of alpha, of excess returns by picking the right stocks within that Magnificent Seven. So avoiding Tesla, avoiding Google, having historically actually not even been involved in Apple. Only more recently, as we started this year, did we start leaning back into Apple, because valuations have now actually become much more attractive than where they were a year or 2 years ago, even. And we're happy to go and talk about any one of these stocks. But I think what's arguably more important is right now we have a small overweight to when you take Tesla and Google into that Mag 7, we sort of now then have a small overweight position to the group. Again, it's about having the right ones. I think that's most important. It's our framework around AI. And if you look at how share prices have done, they've obviously done very well over the last several years. But to a large extent, their earnings have kept up with their share prices. So valuations, we don't think have sort of have moved beyond it. And going forward, we still see plenty of growth opportunity for these companies that we think are arguably well positioned, if not the best position, for AI growth and the ability to monetize that. And again, just thinking about AI, we're still in the really early innings of this trend and this theme.
Yeah, I'm gonna pick up on a few different things you mentioned there. Let's maybe start talking about what you were saying, around, I guess, earnings keeping up with the share price and what the valuations look like. I'm especially interested in discussing Nvidia in that sense, because obviously it's grown so fast and then, pulled back a little bit in the past week or so, but even then, the growth has obviously been spectacular. And so I think a lot of people are wondering, was it starting to look a bit expensive, or can it really keep going like this?
Yeah, no, great question. So maybe I'll just take a step back and give you a sort of how we view the world, particularly with AI. And as I say, it's still early innings, but the view that we're trying to take on this, we think the market's going to broadly separate into two parts. You're going to have your AI winners that are able to monetize AI, that are able to improve their barriers to entry, improve their barriers to profitability on the back of this technology. And then AI is going to probably, go through almost every part of the market to some extent. There will be some parts that it's not touching, but most parts it will impact. And for the rest, they're largely probably going to be AI adopters. They'll have to put AI functionality into their workflows to remain competitive and to remain, relevant. So maybe the best example I've got of this is if you go back from 2014 to the end of 2020, and we look at mobile data growth. Mobile data growth was growing at a phenomenal rate. I think it was something to the tune of 40% CAGR. Huge amounts of growth in mobile data as we were streaming more, downloading more on the go, etc. And what is interesting, though, is the importance of being able to monetize that growth. So if you look at global telecom stocks over that time period, their share prices were flat. All they effectively gave shareholders was the 4% dividend yield of the sector. However, if you looked at the semiconductor manufacturers, and again, I keep talking about them, it is one of our large overweights, but if you look at the semiconductor manufacturers that are tapping into all that data growth, into having more chips on the phones, etc., they offered you to the tune of 20%, 21%, I believe it was, 21% compound CAGR. So a huge amount of growth, because they not only got the volume growth, but they were able to price for it as well. And funny enough, when we think about it going forward, I think the same is going to happen largely with probably telcos in the future. So we talk about all these chatbots that telecoms are going to need to help with their, to help with their sort of cost base. But Most likely than not, I think those are probably just going to be, they're not going to be margin enhancing or revenue enhancing. Most likely all telco providers will have one, and they'll just bring the cost down. And with that, most likely prices will come down too. And then, you talked about NVIDIA. Again, when I think about that volume growth and that pricing and the ability to price for that volume, I think it all looks quite attractive. We see demand for GPUs as, outstripping supply for the next several years. So significant amounts of volume growth that outstrips supply. And over that time period, NVIDIA has the leading edge on their GPU. Now, AMD is coming up pretty fast. They also look to be offering, new GPU chips. We still think NVIDIA will likely have the edge on them. Even if AMD does manage to come up with their own GPU, whether we're in a monopoly or a duopoly, we don't think really matters to the long-term investment thesis of the stock. We still see significant pricing power, and we still see demand outstripping supply. So in that environment, that's a pretty nice place to be, with strong volume growth and pricing power.
Right, still quite a way to go then. I definitely wanted to discuss Microsoft, both because it's your biggest holding and also because obviously we've been talking about it last week quite a lot. I think the obligatory question I need to ask is, whether you think last week's outage will have some sort of like long-term impact. And did you sort of see it, as maybe an opportunity to top up the position, or maybe, as a bit of a cautionary tale of things that can go wrong?
Yeah, no, these things do happen every now and again. They're incredibly frustrating when they do happen, and they impact all parts of the economy, not just the airlines, as I'm sure many people suffered from, sadly. I think long-term, our view on Microsoft is, again, it sort of comes back to that sort of AI framework where they've got a combination of a great software company, but that's not the real attractive part. The really attractive part is a combination of, they have probably the best large language model with their OpenAI, with their ChatGPT, with their Copilot, and their ability to monetize that, despite how nascent that technology is really impressive. The second part, that's arguably the most exciting part, is their cloud computing. And again, demand for cloud computing again seems to be outstripping supply. There's really good pricing power in this part of the market. It's very oligopolistic. All of those things actually work very, very well. And Microsoft is gaining the most market share within that market as well. And it's a combination of having AI tools on their software, all on the cloud as well. Now, what AI really brings to the table, and working at JPMorgan, we have a lot of AI capabilities ourselves, and we understand the importance of having all of your data, not just clean, but having it in one place. And that is why we think AI means cloud computing demand will bring longer duration to that growth profile.
We have been speaking quite a lot about AI is an opportunity. Is it also a risk, and for which companies in your portfolio potentially? Like how do you approach the potential risks that it carries?
Yeah, it's a good question, and again, we're still rather early, but I think where it can be a real risk is if you need to have AI to remain relevant. And we were talking to the CEO of Capgemini a couple of weeks back, and one of the things that they were flagging is to have a chatbot now is incredibly expensive if you want to have a high-end one. And where that may be important in your business line, if you don't have that chatbot, if you don't have that functionality and that service, then maybe you're going to lose market share. So I think there's some parts of the market where it's going to become more expensive to do business and to remain an operator in the market. And likely that's just to be a participant. That's not going to come with revenues. And therefore, those industries, we do think there is a risk to the downside for them.
And how about in terms of the tech stocks? My colleague Arthur Sons, he covers tech stocks and recently was looking at how for companies like Microsoft, Meta, and Alphabet, AI has meant like a really big increase in capital expenditure because obviously they do need to buy Nvidia's GPUs, and so they're no longer maybe as capital light companies as they used to be. Is that something you thought about? Is that a concern in any way?
Yeah, that's a very fair reflection in terms of building these data centers and all the infrastructure around them does change to some extent the dynamic of the business, at least in the short term. Longer term, though, when you have the pricing power, when you have the infrastructure, then you get that sort of more asset-light pricing power back again. But I think actually now that you raised software, you're right. A much larger proportion of what IT budgets are being used on is now being used on cloud compute and AI models, etc. And what that is a headwind for is software companies. And we have began to see over the last quarter, many software companies begin to profit warn on the back of that. Yes, there are concerns of this is coming at a cost, and other places we're going to have to tighten the belt on because the IT budgets can't grow infinitely. And so for that reason, we have a neutral position relative to the market in software. But the main software stock that we hold, which you flagged, is Microsoft, which, as you know, is actually a beneficiary of AI and cloud computing. So we're probably net underweight those companies that are going to struggle with as more of that IT budget is pushed away from software and pushed into cloud compute.
The other thing, which you mentioned already, but it would be good if you could say a bit more about that, was you going back into Apple. What's changed? Can you say a bit more about it?
Yeah, absolutely. So maybe again, just to give you a little bit of the history, we had some significant underweights over the last several years. And our concerns on Apple historically were you've got a set a market that is mature and in decline, that replacement cycles are getting longer. The key beneficiary of, or sorry, the key improvement, I should say, of handsets has actually largely been around the camera. The rest of the improvements, there have been some, but the biggest improvement has been the camera itself. Now, valuations of Apple had got very rich at that point in time relative to its own history, and we were just able to find higher quality businesses at more attractive valuations. Then, with some of the China risks unfolding, with them, banning Apple phones to government employees, etc., with the lack of an AI strategy all the way up to the end of 2023, the stock began to sell off quite aggressively, to the extent that valuations have become quite attractive. Now, our view on Apple hasn't changed significantly. This quarter, they gave us a bit of an AI update. I think there was a few incrementally positive things that come out of that. I think we've got a bit more clarity on what they're trying to achieve. I think as more apps and AI gets done on the smartphone, that's quite attractive for Apple. And I think down the road, we still like the business, a high quality business. A lot of it is going to become increasingly shift away from that hardware piece and more towards the software element of the business. So we still like the business, but what had changed is we got a bit more clarity on that AI, on what they were doing on AI, and the valuation became far more attractive than what it was last year.
I also wanted to ask you a couple of things in terms of, more like broadly various like markets that you invest or not invest so much in. One of them is, what is your view of like UK stocks? Are you able to find opportunities there? How does it look? Because obviously there's a massive conversation going on around it being quite a depressed market.
Yeah, that's right. I mean, the UK stock market itself, has always been on a relative basis skewed towards sort of energy stocks, or skewed towards banks. But what we're much more interested in is whether we can find attractive businesses within the UK market, and importantly, whether they can hold up to global peers and other opportunities that are out there. And that hurdle rate is very, very high. So for us, we have in the past actually found attractive opportunities. We have held things like Relics, where, again, we think they are an AI winner. They've got one of the best data feeds. I think I talked about it earlier, but the importance of having proprietary data that you can price in an AI world, that's important. And Relics, we think, can have, improve their software offering, improve their pricing with new AI capabilities. We still think within their markets, they're relatively early within the legal part of the business. We still think there's a lot of runway for that company to grow there. AstraZeneca, another stock that we like on valuation grounds, relatively good growth profile relative to the rest of the pharmaceutical world. So we think it's got good growth profile and attractive valuations too. And then finally, we also hold Shell. And Shell has done a lot of work to convince the market that it's improving its capital discipline. It's taken a while for the market to give it credit. It's taken, they've been talking about these discipline improvements for 12 to 18 months. And only really over the last 9 months have we started to begin to see the benefit of that as shareholders. But the valuation spread compared to their US peers remains pretty high. So we still have attractive valuations on that piece.
And then I guess a sort of similar question around Japan, where I think you do have a position a little bit underweight compared to the benchmark. What's the outlook there? Because obviously it's a market that is changing a lot compared to what was its reputation until a few years ago.
Yeah, absolutely. So with Japan, great stuff that they've done in terms of corporate governance improvement, and the stock market has done well on the back of that. I think when you look at maybe the amount of improvement, I still think there's a lot more that needs to go to justify some of those valuations, and yet to be seen. Everything is moving in the right direction. In fairness, I think they had one of the best years of buybacks that they've ever had. So record buyback for their stock market. For us, it's about finding high quality businesses, again, that stack up to global peers. So for us, we only hold Shin-Etsu in the portfolio today. So Shin-Etsu is a Japanese listed global chemical company. It produces two things. It produces PVC largely, which is used in infrastructure and housing build. Now, that's not a particularly attractive growth profile as a business, but it is cash generative, and they've got one of the best cost structures and good operators within the industry. And the second part is within, they produce wafers, and that's where we're much more excited. We do see attractive growth profile. So wafers are what we use for what are used to sort of put your chips on. And we do see, as I say, attractive growth in that part of the market. And for what is trading now, quite an attractive valuation, Shin-Etsu.
I think we were mentioning at the beginning how, you invest a bit across like different styles and have in general quite a flexible strategy from that point of view. What is the balance of the portfolio at the moment around growth value? Is there anything you're favoring?
Yeah, it's a really important point. So we always want to be a core portfolio. We always want to remain in the core universe, balance between growth and value. And we think in the grand scheme of things, there's not much edge to be had between the growth value debate. We think what's much more interesting for shareholders is to not play that, but to get a balance and just get the best companies across that entire cohort. And despite the fact that growth has actually been on a very strong performance over the past 15, 20 years, if you look much further back through history, there were very, very long periods that value had outperformed growth. But within that, we will tilt the portfolio to where the most attractive valuations currently sit, where we have the most insight, where we think earnings are looking most attractive. And for us, right now, that's leaning a little bit into growth. As we said, that's predominantly through the semiconductor cycle. That's how we have a little bit of a growth tilt in the portfolio today. We've pulled that down quite significantly because growth has actually performed very, very well. And on the back of that, we've taken profits there. But at the end of the day, what we do want to make sure is coming through is our stock selection. I think that's actually an important point. So we want that the excess returns of this portfolio are driven by stock selection, not being driven by a value or growth regime within the portfolio. And what you can see is over the past 5 years, we've basically gone through 3 major style regimes. We went through a growth regime from 2019 to the end of 2021, in which the investment trust outperformed the market by roughly 8% over that time period. Then in 2022, when growth had done very, very well, inflation had picked up, rates picked up, and the value stocks began to work. And over that period, we managed to deliver another roughly 8% cumulative excess returns above the market. And then finally, since the launch of ChatGPT, we've been in another AI-fueled growth regime in which we've delivered around 8 or just over 8% cumulative excess returns as well. So hopefully showing to our shareholders that our stock selection is what is driving the performance of the strategy rather than it being driven by growth value.
And yeah, what will the next cycle look like?
Well, that's the key debate. It's always hard to say. Growth stocks offer some pretty attractive growth opportunities. Valuations have been on a bit of a run. We still think the best place to play it is not making that decision and staying with a core portfolio like JGGI.
Yeah, of course. Just one last question, James, which is sort of more related to the trust than to the underlying portfolio. So I was mentioning at the beginning that the trust is one of the, well, basically the only one in its sector that is trading at a small premium. But then there's a lot of discounts going on in the investment trust sector in the UK, and that has obviously generated quite a bit of M&A activity within the investment trust sector. The most prominent example being Wheaton being acquired by Allianz Trust. What is your view of the sector at the moment? Do you think we will see more of that? And in that sort of M&A space, could the trust potentially get involved?
Yeah, absolutely. So there probably will be more of that coming forward. I think these deep discounts and the opportunity when some investment trusts trade at premiums. I mean that's an attractive. There's attractive deals to be done on the back of that. How it happens. That's more of a question for the board. It's their decision on what they want to do and when opportunities come up. But personally, I think there's probably more to be done. Is my best guess.
That makes sense. Great. Thank you very much. It's all we have time for today, but thank you for coming on the podcast. And thank you to our producer, Maddie Athorpe. And thank you all for listening to the IC interviews.
Thank you very much, Val.